kick off with the first presentation, please. All right, good. There we go. In the first few slides here, we're just looking at a number of representations of the crisis. And I guess this is relevant in particular from a SWIFT perspective because the speed with which the economy is operating has a big impact on what SWIFT does. SWIFT itself, being one of the key pieces of the global payment system, is clearly going to be affected. The rapidly increasing public indebtedness, I thought we might just pause on that simply because the rapidly increasing public indebtedness has one good effect, which is going to be extremely relevant to all of our discussions on liquidity. It makes available an extremely a big increase in the supply of highly liquid government bonds. That is one thing which we may find we're short of today, but governments are working on the problem. The write-downs from banks, let's just think about this from one perspective, which is if you take these figures as I'm sure they're not exactly right, but order of magnitude, they probably are, they represent losses of 2.8 trillion. But that's losses of 2.8 trillion. And you have then to remind yourself what the generic asset classes behind those losses is and what its scale is. You're talking about a very significant portion of the entire global banking portfolio has experienced some of these losses. So they are extremely widespread. The impact of those losses and the scale of them, generally outside the scale anticipated, has led to a reduction in the liquidity of considerable numbers of asset classes. So SWIFT as mirror of the economic environment, not just physical goods, as we'll see in a moment. I think it is interesting that this is the first time in the history of SWIFT, which goes back, and if Mr. Reimakers were here, he would be able to confirm this to you, but I think SWIFT was founded around about 1970-something. Does anybody actually know? I don't actually have that number at my fingertips, but this is the first time that global payments traffic has reduced, which I think is an interesting measure. And you can see that global payments traffic, as measured by SWIFT payments, very consistent with GDP growth, which might or might not meet your expectations, because obviously SWIFT payments are not simply covering trade, they're also covering investment and trading flows. And you'll see here in North Asia, we're looking here at customer payment messages and throughput in Hong Kong. That's a pretty good correlation. You'd want to, if you had the inclination, which I'm sure none of you do, you'd want to model that. But it's just pause and think about the scale of this. This scale is 20 times larger. And you'll see there's a very similar correlation. And here, what we're looking at is the relationship between SWIFT payments and New York Stock Exchange trade volumes. And once again, you'll see this is, well, it's not a perfect correlation, but it's awfully close. It's awfully close. Wim Reimakers was making the point that liquidity risk is a sort of a central risk, and everything else links into it. So every time a counterparty defaults, all of us have the potential to experience a liquidity problem when they fail to make payments. Every time a market price falls, we have some contingent impact on the way in which we calculate either our reserves available to meet liquidity claims or alternatively just the value of our assets in general. So all of these asset risks feed into liquidity risk, which is probably, I think it's fair to say, has been underrepresented in people's thinking over the last 10 years. And here is a slide which has come from Oliver Wyman. And I guess the key point, you can read the slide for yourself, the key point here is that one of the critical inputs in this crisis was not that we had asset quality problems. We've had asset quality problems in every banking crisis for the last 400 years. In this particular crisis, what we had was asset quality problems which wound up creating a generalized concern about liquidity. And in particular, in the latter part of 2008, there were some movements in asset prices which reflected a sudden realization that the theoretical value of some of these assets, that is their underlying creditworthiness or their potential value, which should not, according to most people's thinking or many people's thinking, should not in truth have changed, it was impacted by the fact that there were only sellers of certain classes of asset. And we all remember that in late 2008, some of the asset classes in which prices fell under heavy selling pressure were asset classes not that people wished to dispose of, but they were asset classes where there was still some liquidity, and therefore people were reaching for anything which might be sold and converted into cash because too many alternative sources of cash had already disappeared. And it is this impact of waves of sellers that's a, I think, distinctive feature of this crisis. A rather busy slide, but you get the general drift. This is going back here over really just over a year, and it's trying to list out all of the various measures and proposals and reviews which have been looking at liquidity, treating it again as one of the key issues to come out of the crisis, and trying to come up with some suggestions for how the world can be made a safer place in this way. And there's a huge range of material here, and we'll probably get to some of this, I think, in the panel discussion. Now, I think this is a key slide. It's one of the reasons why I was very reluctant to leave out this presentation. The size of the bubbles, I think this again has been put together by Oliver Wyman. The size of the bubbles represents an attempt to capture the impact on our industry of some of the regulatory reforms as they are currently proposed. And you can see, and it won't surprise you, I think, at all, that the red bubble, the A, the largest one, this is the impact on profitability of the changes in capital which are being discussed. I can't tell you exactly which changes Oliver Wyman assumed we're going to get into the Basel model, but there's a sort of a central path that one can assume. And you can see that this is a big impact. This is a big impact. And incidentally, to give you some sense of scale, Oliver Wyman published some material which suggested that the impact of the various reforms that have been proposed so far, the impact on bank ROE, and they're talking globally, so it's a slightly fluffy number, they believe the impact may be a 30% reduction in bank return on equity. And that, of course, is before we as bankers seek to try to pass on these costs to our clients. And I'm sure most of you would share with me the impression that passing it on to clients, if it's a move of that scale, is going to be difficult, if not impossible. So these are very big impact regulatory reforms. The largest of them is capital, but the second one is the liquidity changes. Big, big impact on bank profitability. Oops, I'm sorry about that. Wim Rijmakers was trying to get here at some of the actions which it's incumbent upon on all of us to be taking in this environment in which our attention has been focused so sharply on liquidity. And he's talking here about the challenge. Essentially, the biggest single challenge, I think, is the challenge of getting appropriate data. And he's broken this somewhat into two pieces of intraday liquidity management, so getting a really serious grip on payment flows in real time as they happen, which, of course, from a SWIFT perspective, is simply critical. And also, of course, the bigger picture, the macro. So there's a bottom-up liquidity challenge, which is the details of each payment and aggregating them real time. And then there's a top-down liquidity challenge, which, if you like, let's encapsulate as an attempt to create stress tests for liquidity, which is a top-down, will tend to be a scenario-driven approach to liquidity management. So I think that I think takes us through most of the points that Wim Rijmakers was going to make. So I think that should be an introduction for us. I'd like to invite Mr. Ramakrishnan to come up to the podium and talk to us next, and then we'll get back to the panel discussion.